These returns can point to potential opportunities such as calendar spreads over the weekend, and if you don't know what a calendar spread is, I've got it on a Reddit. You can go check that out. But right now, I'm going to walk through the Unusual Whales Options Profit Calculator real quick, show you guys how to create a calendar spread. But let's go over to create this for the UVXY. So go into the Unusual Whales Options Profit Calculator at unusualwhales.com/OPC. We can see what the UVXY is trading at. We can look at the open interest, put call ratio, bid-ask spread, implied volatility, option count, everything, social security number, the UVXY's mother's maiden name, I mean everything. So calendar spreads are composed typically of a near-term short call and a further-term long call on the same strike. Expiration of a calendar spread is purely a volatility play. Near-term short call, you're expecting volatility to fall, therefore decreasing the value of the short call. Following the expiration of the short call, you're expecting volatility to rise, which would increase the value of the long position. So that Friday, you're expecting volatility to fall. Now, why would volatility fall on a Friday? Even though we see the VIX going up on a Friday, most contracts are expiring on Fridays for the S&P. So people will be rolling out of their VIX positions, and volatility should be falling because they're just getting out of them. So that's the play with this. As far as Monday, since we see the weekend effect pop, you most likely be able to try to arbitrage that. Now, I know I said earlier you can't do this on UVXY and VXX. And I'm not saying that you can't truly do it, but it's less reliable. This is a volatility play. It's not UVXY going up and down. It's the implied volatility of UVXY and VXX going up or down. So regarding the VIX and like indexes, we're seeing a statistically significant return on the VIX on Mondays. So volatility is higher than normal, which allows great strategy surrounding the weekend effect with calendar spread. UVXY currently trading at 16.32 a share, so we'd enter the short 16 strike for this week's expiration on a Thursday or Friday, and the long 16 strike for next expiration. Now, this can get scary. Yeah, this is in the money. You can go out of the money too. You can go as far out of the money as you want, or as far in the money as you want. But we are expecting UVXY to fall a little bit. So, since contracts that are in the money have a higher implied volatility than contracts that are out of the money, you might be able to get a little bit more dollars out of this by playing it in the money. Now, you run the risk of being assigned, so please be careful. So, the expected payoff would be range bound. Since volatility, or in this case IV, decreases with a lack of movement, the volatility of the short position should be negated with neutral or upward movement in the near term, with volatility peaking that next day after expiration for the long call, and max profit coming if the UVXY is trading around 15.98 on that day as well. So we can see the P&L chart here. This is your peak. This is not an expiration, this is the next day. So if you enter this on a Thursday, you could expect to sell this on a Friday. If you enter this on a Friday and choose to hold through expiration, if your sold call expires out of the money, you're chilling, and you wait for Monday and wait for things to hopefully open green. This is not a strategy to make 600-700%. It's not. This is a strategy to make 4 or 5%. Now, you can run this on the S&P 500, on SPY. That's a great place to try it. So you could sell a call at whatever on Fridays, and on Mondays you could long a call on the same strike, but different expirations. So that would be a place that you could try it.